Good. So is there any consensus on the number so far?
We've got around 10 million
okay.
It's been echoed by a couple of people.
So I think I'm on the low side. My feeling is, personally, own my house outright and have 5 million of free cash, investable assets or free cash. Because, you know, I'm older than a lot of people in Foundrs, as I've said on some of the messages. But so I'm kind of thinking, what would fund a really comfortable retirement? And I think, you know, house plus 5 million is enough. I'm not a Ferrari and boat kind of person, but if people have bigger ambitions, then obviously that 10 or 15 becomes more justified.
And I think it depends. Like, so, you know, in the UK, you know your number, but actually if you go to elsewhere like Australia, then the property price is just going to be astronomical. And if you go to maybe Costa Rica, then your number can flex.
Absolutely. So I'm going to jump in. Love these discussions and love everyone sharing their thoughts. It's all really helpful. But first of all, welcome everyone. And first thing, bit of housekeeping is that if you wouldn't mind staying muted throughout the first half of this, that'd be super helpful. I'm going to hand over very quickly to Luke and Nick from Evelyn Partners, who are our expert sponsors in wealth management in Foundrs, and have worked with a couple of members throughout the community. They have over 10 years expertise working directly with entrepreneurs. So I'm very excited for them to share their thoughts and wisdom. So over to you, Nick and Luke.
Big intro. Even more sadly, it's 10 years working together in Evelyn Partners. So we've been doing this for a while together now. So I'm correct. Luke's face is ingrained onto my retinas. But what we're going to try and do today is there's lots and lots of different things that we can talk about around wealth management and financial planning. So some of you will be very up to date and expert in certain areas, some won't be at all. So what we're going to try and do is do a run through the principles that we use to, you know, start conversations and some of the structures that might be there and how you might structure a portfolio. I expect some of your eyes are going to light up at certain parts and then some you might find dull. If it's all right, what we'll try to do is cover all the questions at the end. And if any of you want to have a conversation one-on-one offline about anything that we talk about today, please just drop us a line. If you don't mind, I will share some slides. So bear with me 1 second. I'm not going to spend too much time on this, but this is kind of why do we feel like we're in a good position to talk to you about wealth management and what is it we do and why are we part of the Foundrs group. So some boring numbers on there. We look after 52 billion, which means we're of a size. We've been doing it for a long time. We've been around for 186 years. I think if I was going to draw your attention to one thing on this page that sets us apart from others, it's in the top left. And it's the fact that we're tax advisors, accountants, and wealth managers. So they're all, you know, quite staid, boring professional services terms. In reality, what it means is when someone, for example, is coming towards a transaction, we can help them with the forward-looking plan. And that's what today's all about, the forward-looking plan, but also make sure that they're not tripping over any tripwires from the tax perspective. So we've got a couple at the moment where they're being entrepreneurs advised by tax advisors. They've got a very nice, neat way to get assets up to a certain part of the company, but they've not thought about what that person wants to do with the money afterwards. So we've intervened and we're looking like we might save them about 20% in unnecessary tax, just because we're thinking about that double edge. So anyway, that's one thing. The other thing we try to do, and you know, I know a lot of the people on the call just recognizing some faces have been part of this, and actually, sorry Graham, but I'm using your image there, is we try to bring together the community. So not only are we trying to, you know, give the right advice and the technical advice, we're trying to help in other ways. So, you know, we do that from informal dinners. We have our Hall of Fame where we try to tell exciting stories about people that have done interesting things. And then the logos that you see scattered around the screen are people that we've had come and share their story with our group in the past. And actually, Tomorrow morning, we've got Aaron Gelbard from Bloomingwell speaking. So if you do want to come along to that, drop me a note. So what are we going to talk about today, and then what are we not? Just as a reminder, this is all about long-term financial plan. What do I do with capital after I've sold? Even though the conversations might come a little bit before. And that's what we're going to talk about today. We're not going to cover specific tax things around, reporting to HMRC, structuring actual transactions. But if there's anything that you do want to talk about on that, give us a shout. There's just too much to cover if we do it that broadly. On financial planning and investment management, we've kind of already touched on this with AJ's initial question. Investment management is the, sometimes seen as the glamorous bit at the end, and finding those 10-bag of stocks and maybe investing in NFTs or Bitcoin. I'm sure we'll get onto that later on. But before all that, it's important that you build a financial plan. So what we do here is we help people find that number, and it's based on whether you're going to go abroad, whether you're going to buy Ferraris, whether you're going to enrich the kids early or whatever it might be. But we always try to start with working out what that number is before we start to invest. So what we're going to try to do today is I'm going to hand over to Luke, who is a financial planner. I'm the investment manager, and Luke will take you through some of the basic principles and then pass back to me, I think. So over to you, Luke, on the financial planning bit.
Yeah, thanks, Nick, and hey everyone, good to see you. Thanks a lot for joining our session. So, look, as Nick said, I'm the financial planner, and I've spent the last 10 years working with individuals that are creating liquidity events on business sales or business exits. And for me, it's been a much more exciting and rewarding space than the 10 years previous to that, where I worked with accountants and solicitors, and frankly, the plans were very, very different. For me, my job is to devise plans that are bespoke to the individual, their family, and their objectives. And one thing that is absolutely key about working in your space is recognizing that your scenario is just materially different from the average city worker. Ultimately, Nick and I are going to create our wealth over a 40-year period, and we're going to retire and spend it over 20 years. And that's a very, very different journey to the one that hopefully you guys will be on, and the plans need to differ to reflect that. The starting point, though, is always the same. The starting point is always about making sure that the right foundations are in place. If you haven't got the right foundations, you can't build the house. It's as straightforward as that. And for me, there were three key points in this regard. So the first is about protection, making sure that you, your family, potentially your business, are protected from the worst case scenario, death, disability, long-term illness. The second foundation is to think about debt, and particularly to make sure that debt is under control. I still meet people today that have credit cards but no mortgage. That's just inefficient. So debt's fine in the right circumstances, but making sure it's structured in the most appropriate manner is a really important starting point for us. And then finally, before we get into the exciting world of investments, is just making sure that people have got the right cash reserves, effectively that rainy day pot that our grandmas told us about when we were growing up. That number, the rainy day pot, will differ for each of us. Some people think about 6 or 12 months spending, but frankly, if you're running your own business, particularly pre-profit, the figure could be materially different. And Nick and I can certainly work with you to help you find that. The key part about the foundation, though, is that you should be doing this now. That's not at point of exit, I'll get this stuff sorted. Making sure you're protected, making sure your debt is organised properly and making sure that you've got a cash buffer should be a focus for all of you, right now. When it actually comes to sort of saving and investment, so putting some money away, as a financial planner, what I'm trying to do is to ensure we're tackling things as tax efficiently as possible. Nick will create value by taking risk. Tax can destroy that value if you don't plan properly. And our starting point, as you'd expect, is just a matter of taking advantage of easy wins. And this slide shows a few of those. I won't sit in and work my way through it entirely, but there are tax allowances, dividend allowances, capital gains tax exemptions that enable you and your family, if you plan properly, to keep more of your investment returns. And yeah, the slide sets out the numbers. In terms of sort of seeking to invest tax efficiently, using the right tax wrappers, the sort of low-hanging fruit is so important. And I'm sure everyone on this call has heard about pensions and ISAs and probably have views, positive or negative, on them. For me, these are easy wins, and again, are wins that you should be taking advantage of now, pre-liquidity, if you possibly can. Now, I appreciate that pensions are, sort of don't have the most glamorous of reputations, and I've worked with so many business owners over the years who have said, look, my business is my pension. I'm going to sell for 5, 10, 20 million. So, why do I need to put X £100 a month into my pension? And sort of fingers crossed that they're, that they're right. Probably what they're missing is sort of the huge tax efficiencies associated with pensions. They're one of the vehicles that allow you to take money out of your business without tax cost. And frankly, if you do sell for 5, 10, 20 million, then the pension is the one vehicle that you can pass to, children, grandchildren on death, without any inheritance tax. The one thing I'd say to each of you today is getting started on a pension is actually by far the most important thing. And that's because pension allowances operate on a carry forward basis. So much of what I do is sort of use it or lose it. Use your ISA allowance or it's gone. Use your tax-free savings allowance or it's gone. With pension allowances, you can put 40 grand a year in, subject to certain rules. You don't actually have to use it. As long as you've got £1 in a pension, you can carry forward that allowance for up to 3 tax years. So if you're planning of exiting at some point in the future, set up a pension now, put a pound into it so it's live. Pre-exit, theoretically, you can look at extracting from your business the 40 grand for that given year, plus the 3 lots of 40 from previous years. So 160 comes out of your business into your pension tax-free, long before the old 10% entrepreneurs relief and CGT rates apply. So some simple planning you can do now. ISAs and whatnot, I won't spend any time thinking about. You guys can read the slide as well as me. I guess what I wanted to think about next is about post-liquidity wrappers. So Nick, if you can move on. As I said earlier, your typical city worker will work for 40 years, retire for 20. So Nick and we can build our retirement pot. We can work towards our number over a long period of time. Use your pension, use your ISA allowance each year. We'll deliver our figure. For entrepreneurs and people who are creating liquidity, ultimately you need to be more strategic. And for me, that opens up a range of structures that are not common amongst the man on the street, but are common amongst your peer group, and importantly are sort of known and understood by HMRC. So we're not talking about tax avoidance schemes here. We're talking about different structures that you can put material capital sums in, sort of post-liquidity. This slide sort of aims to summarize. You'll see the first line, we start with what we would describe as directly held assets. So basically, they're just investments that are made in your personal name that is not in some form of tax wrapper, not in a pension, not in an ISA, or any of the other ones that I'll come on to talk about. And the sort of basic principle here is that tax applies on what's known as an arising basis. So you pay income tax on the dividends as they are generated, you pay capital gains on gains as assets are sold, and importantly, those assets sit in your estate for inheritance tax purposes. So you're sort of naked as far as the taxman's concerned. Doesn't matter whether you're spending that income or reinvesting it. Ultimately, you've got this tax drag year by year, and it's that we're trying to avoid when thinking about other structures. Now, we haven't got enough time to go through them all in detail, but just to highlight a few key points. The family investment company, I'm sure many of you will have heard of, certainly popular in the entrepreneurial community. Ultimately, a FIC, a family investment company, is just a corporate that is sort of purpose built for investment rather than trade. There are potential tax efficiencies associated with it, in as far as investment gains are subject to corporate tax rates as opposed to personal tax rates. But you've got to be really careful about how you extract the money. That's something that we can help with at Evelyn. And one of the reasons these are popular amongst your community is that you can use different types of shares for sort of different members of family. So quite common for mine and Nick's clients to bring children in as shareholders to the FIC, but on a sort of no voting right, no right to dividend basis, just so that growth can be passed, excess growth can be passed to them over years, with a view to sort of saving inheritance tax. FICs sort of came to the fore when some trust rules changed back in 2005. Before then, sort of business owners put all the money into a trust. That's why, the McFitties and the Cadbury family and the Guinness family have just got these enormous trust funds, because the rules were quite different then. They'll be less relevant for this peer group, but there are still ability to put some money into trusts on a rolling basis. The magic figure is £325,000 every 7 years. And that's something that Nick and I build sort of systematically into our plans as well. And then the final one that I'd highlight now is an offshore bond. And I'm highlighting it because it's got the word offshore in it. Some people will sort of recoil in horror, think, crikey, I can't be hiding things from the tax man. The important bit is that these structures are set up in jurisdictions that have sort of reporting agreements with HMRC. Ultimately, they're just a tax deferral vehicle. So instead of paying tax on an arising basis, returns roll up on a gross basis. So you keep all of return. That means you can grow the growth over the years. And one of the reasons that these have been so popular with the clients Nick and I work with is that you can change the ownership on offshore bonds without triggering tax cost. So often we'll put money into an offshore bond and say, look, we think this is the surplus. I was aiming to sell for 10, I've sold for 20, I'm putting 10 million into my offshore bond. I don't think I need it, but I want to control it right now. And then potentially you can change ownership to children, grandchildren later down the line. Next slide, please, Nick. So, for me as a financial planner, and certainly working alongside Nick, I'm the more cautious of the two. You know, part of the reason this works is that we balance our views against one another. For me, we live in an increasingly uncertain world, and really the only thing that I'm certain of now is that there will be tax change ahead. And something that I try and build into all of my financial plans is as much flexibility as possible. And for those of you who've met me, will know that I talk about a sort of patchwork quilt approach to tax planning. So I wouldn't ever sit there and say, the pension's the right strategy for you, put all your money into a pension. The FIC's the right strategy for you, put all your money into a FIC. Ultimately, what I try to do is build strategies that blend tax approaches to give me ultimately as much flexibility to adapt to my clients' lives and needs changing, but also tax legislation changing. And look, as I said, I describe that as a patchwork quilt. I'm just trying to build in as many levers, as much flexibility to adapt to future change. To try and bring that to life, this slide sort of shows a plan that Nick and I built for a real life, a real life client. On the far left hand side, you'll see some cash reserves. So we started with those foundations. What is the right amount of money to put away to protect this couple and their children? And in this scenario, there were school fees at play, so costs, ongoing costs and commitments were relatively high. So that was sort of stage one. Stage two was about those easy wins, so investing in pensions and ISAs each year, subject to affordability, just to be utilising the allowances. And then when we got to the point of liquidity, excuse me, that's where life became more interesting. And hopefully you'll see in the middle of a picture, we've got an offshore bond that is feeding into a medium risk investment portfolio, but also a family investment company that holds a buy-to-let portfolio, private company investments, and liquidity. Excuse me, I've got a cough. On the far right-hand side, we've got assets put away for children, trust, junior ISA, and pension. Next slide, please, Nick. It's inevitable when you present, you get a tickly cough, don't you? Okay, so that was the day one plan. Post exit. Sorry, Nick, back.
Oh, yeah, sorry, excuse me.
This is what the plan looks like over decades. So we've spoken about Excel. Somebody said earlier, I need to get on Excel. This is my equivalent. So I used to do my planning on Excel, but in my experience, it wasn't great at adapting to those sort of what if questions. What if inflation is higher? What if investment returns are lower? What if my circumstances or needs change? So this is one of my financial plans built out over sort of decades. And hopefully look at the bottom axis, you'll see that we've got a sort of 4-stage approach here. We've got a pre-business sale phase. We've got a post-business sale phase, which I would describe as the active retirement period, when frankly you're spending and enjoying yourselves most. We've then got an inactive phase when crudely our clients are older, they typically spend less. And then frighteningly, the later life phase, which I dare say some of you may be seeing with your relatives, where frankly people need some help and life can be more expensive. You'll see lots of different colours. The spikes that I would sort of highlight is sort of 6 years in, that first purple spike. This is the business sale. So we've got a material amount of liquidity dropping into this chart, which we describe as a cash flow chart. And incidentally, in this scenario, the amount being paid in is 5 million. So it's more closely aligned to Graham's sale figure than the £10 million figure that lots of you said, and actually I hear very commonly in the marketplace. Now, clearly I could have put an enormous number down on any chart we present for you. This is a real life client scenario. This particular individual exited at this value. And I think it's worth sort of highlighting the fact that it isn't that 10 million so big I don't need to worry number. It's 5 million I need to plan properly number. And I think it's important to highlight it because you know, a number of corporate financiers over the years have told me that, you know, they meet a lot of great businesses but are frustrated at how many deals fall down because the founder doesn't necessarily understand their number, the right amount that they need to deliver, you know, deliver their long-term objectives. So this sort of modeling is a great tool to sort of say, okay, well, you want to spend 10 grand a month, you want to, you know, you want to pay off your kids' student loans, you want to buy them properties, etc. This model will help us investigate what's enough. You'll see purple spikes 2 years out from the original liquidity. That's just earn out dropping in, so an extra £500,000 dropping in year by year. And hopefully you can see some turquoise spikes as well, 4 of them at £250,000 a piece. In this scenario, the client was making gifts to children and into trust to make provision for later. Nick, if you could skip on to the next slide. What we just saw was the cash flow. This is what we would describe as the liquid assets chart. What is our client actually worth in the background as they're spending their £10,000 a month net of tax? And you know, what you'll see here is we've actually got a growing asset base, different colors at different points, but a growing asset base. Importantly, the green line at the bottom is our emergency reserve, so the amount of cash that we will always hold for our client. Beyond that, what you'll see is the dark purple bars. That's the taxable assets on day one post sale. They're being run down partly because we're using them for spending, but partly because me and my team are systematically funding pensions and ISAs, the pink and the teal coloured bars, year by year. So we're working hard every year to maximise how much of a return we keep to increase the tax efficiency overall. At point of death, so if you sort of look to the far right, which is clients age 100, there's only 2 colours left. Teal, which is the pension fund, and hopefully you'll remember I said earlier that that's the bit that is inheritance tax free if you leave it behind. And then the sort of purple, which is my offshore bond, which again you might recall is the asset that we can gift away. So frankly, for this type of individual, if we're sort of looking at things in their 60s, 70s and 80s and saying, look, it looks obvious that you've got more than you need, assigning an offshore bond to children or grandchildren to get off and do their own thing is a potential. Next chart, Nick. This is exactly the same picture, but adjusted for inflation. And that's obviously like a major hot topic for everyone. It was mentioned in the chat earlier. You know, higher inflation has an impact. Now, we've got a long-term view as a house on inflation, and effectively what we've done is we've stripped that out of this particular chart. And what this shows me is that although there'll be some movement in asset values, ultimately as this individual turns 90, we've effectively protected their asset base. And it's only as they go into that later life phase and the sort of spending really ramps up, as does the taxation, that their asset base starts to decline. I was working with one of our exited clients literally last week, shared client with Nick. He's mega concerned about inflation. He didn't want to look at the chart based on my numbers. He wanted well, what if inflation is 6, 7, 8, 9%? What does that do to my asset base? So we sat there and we played that out live for him and his spouse. and frankly got him to the point that he was comfortable and could carry on with his, life. For me, modeling in this way is really, really valuable. As I've said, I'm the cautious guy, so I can build the picture. Ultimately, the model is only as good as the returns that are delivered. Because I'm cautious, I have assumed for this particular client a long-term return of inflation plus 2% net of fees. So if inflation was 3%, then my rule of thumb is that this client is expecting a return from their portfolio of 5% per annum. If inflation were higher over the long term, history will tell us that stock market returns will be higher. But fundamentally, we need a team to deliver that return year by year, decade by decade. And ultimately, that's where Nick comes in. So over to you, Nick.
Cool. Put your voice back on some ice, Luke.
Yeah, thanks.
I nearly had some emergency water shipped into the room. Right, I'm conscious of time, so I am going to go quickly through my bit because I know that it's a fairly well-trodden path for you guys. But if there are any questions, we'll have them at the end or I'll take it offline. So Luke and I used to impress this graph upon people, and it was frankly very dull because we were telling people that have a 50-year view, you need to do something with your cash because inflation is going to erode the real purchasing power of that money. We don't need to do that so much anymore because you can see this graph is about to turn even more ugly. But that's in normal environments what inflation can do to £100,000. So you've got to do something with it. So what do we do? How do we approach things? Again, this won't be new ground for lots of you, but very basically, if you're a risky investor or if someone's talking to you from my world about risk, the word you should be hearing is volatility. They're talking about how quickly things move up when things are good, how quickly they move down when things are bad. The most volatile asset class that most wealth managers, pretty much everyone, will buy on your behalf will be equities. So if you're a very risky client, you want volatility, you're willing to take risk, you're likely to have a portfolio that's about 100% equities. Okay, so typically people with very long time horizons that aren't putting the vast majority of their wealth into the market, they tend to be higher risk, they tend to be higher equity. Generally speaking, as people don't need to take as much risk, and typically that's near retirement, whether that's because they're 65 or just sold a business, they take a bit less risk. The way we control the risk in that portfolio is by changing the mix of assets. The more dull, benign return assets are fixed interest and alternatives. They still give a pretty decent return, nowhere near the long-term return of equities, but nowhere near the volatility. So a lower risk client will have a higher percentage of fixed income. Most people sit somewhere in the middle, and that's how we manage risk. This always comes from a discussion with Luke and his team about how much we need to take, how much do we want to take. And you can see underneath there's some stats about what a terrible year looks like and what a great year looks like for each of those categories. So not big surprising stuff. So this is just some real live numbers around that, because a lot of that stuff's theoretical. So I don't know if you guys can see my mouse.
Yeah.
Right, fine. So here you're seeing the SONIA rate, which is effectively the zero risk return rate. So not many people hold that unless it's very, very cautious money. I'll come back to that. This here is inflation measured by CPI. Again, you can see it start to tick up. The yellow bar is the UK equity market. So you're going off and you're just buying blindly the whole UK equity market. Each of these other bars, which you can see pretty much move in a very common pattern, are multi-asset portfolios. So they're kind of, a wealth management client where somebody said, hey, Nick, I don't want to see much downside when things turn ugly, but I do want you to go off and make me some net of inflation money. That might be one of these cautious investors where they've made over a 20-year period about 4.5% after fees. So that's the portfolio doing its job. That steps up with the more risk, surprise, surprise, up to the portfolio up here, which is, this is as at the end of June. So you can see it's got horrific year we're currently in there, and have made about 7.5%. So that's, you know, what a wealth manager should be achieving for you in you know, in more customary type portfolios. I've got clients that say, I like that, Nick. I think that the US market is the only place to be, and then the results will be much more pronounced than this. You know, so this is all very tailored, but that's just headline stuff. I am racing a bit because I want you to be able to answer questions. Now, in these types of talks, we don't that often talk about current market situations, but it's a really weird one. So I thought I'd give you my sort of brief take on it. So this is returns as at 30th of August for different equity markets geographically, commodities. You know, you can all read the signs, but what's really stark about that is there are two big bars to the right, and everything else is having a tough year. What does that mean? Why is that happening? Well, the two bars to the right are oil. They're, you know, it's mainly what's going on in Ukraine, but also inflationary pressures. And what's happening with the rest of the market, we feel, is that there's a general feeling of caution. And when there's a general feeling of caution, people generally speaking, particularly ones that aren't that well advised and have too much money in the market, they'll take money off the table, and that causes downward pressure on markets. And we feel that that is one of the primary reasons that you're seeing these shifts across the globe, across different sectors, negatively so far this year. Apart from the UK. So why is the UK, you know, benchmark doing so well this year? Well, about a third of the UK benchmark is oil. So if you dissected, you know, if you went under the hood of the UK market, you're going to see a similar trend where they have these two big outliers of oil this year. So it's a strange market. So this is just a long-term graph of returns over a global index, and you can just see some of the big sort of well-known historic market crashing moments over the period. It's kind of a reason to be cheerful. We tend to find, and my compliance department will probably beat me up for this, we tend to find that things recover, and you know, quite often when things are not going so well, as long as you can identify decent companies that are resilient with decent themes, you know, there's money to be made if you can afford to take the long-term risk. And I guess, you know, just out of interest, the types of things that we look at is, you know, we try to look at markets and identify themes, some of which are incredibly obvious, but, you know, consistently lucrative, like online services. We've got their global consumer, you know, that's people around the world sort of shifting away from poverty and starting to spend money on, you know, products like, well, there's luxury products there and things like snacks that might not be so good for you, but, you know, people do indulge. IP heavy businesses and cashless society, which all sound super obvious, but they're all trends that still have some way to go. So that's just a bit of an insight into how we're thinking. What I thought I might end on is a very busy slide, but hopefully a reason to be optimistic. Again, with all the mega caveats that past performance is no indicator of future performance. So what I've got here on the slide, hopefully you all can see, is lots of companies that you'll recognize the names of. And there are two lines on this chart. And, you know, this is hopefully something that maybe maps across into what you guys are doing in your own businesses as well. Investors like us tend to prefer businesses that are still resilient or making money despite what's happening in the markets. So two lines that you'll see on each of these graphs is one, the blue line is the revenue of that company, and the black line is the current share price. So what you see over a long-term trend is that there's been a reasonable level of correlation between the share price and companies growing. Why wouldn't there be? You know, they're going off making money, new territories, innovating, taking market share, and that maps across into the revenue. What you'll see in most of these charts is sometimes there's just a common blip. So for example, most of the charts see some what at the time was a huge drop off in percentages around about this time, which is March 2020. So in that time, the companies underlying in these cases, and I'm definitely not advocating you to buy these, but it's a way to sort of look at your own investments. Companies that are making money and have cash piles and are profitable and remain so will weather the storm. So these big share prices that you're seeing come down here, they just at the moment don't seem to necessarily map against what you're seeing in the underlying company reports. So I only say this as hopefully a reason to end on a more cheery note, because you can see that there's a very consistent trend there. And actually, some of the companies that we look at and monitor have been reporting in what is a very tricky time where there's a lot of panic in the streets. And these are sales growth year-on-year numbers for lots of these companies. So you can see for lots of them, it's just been an absolutely bumper year. And they've managed to do that with really quite favorable operating margins as well. So I'm not saying that this is in any way the end of the uncertainty, or this is on the up. What I'm saying is it's easy to sell papers with negative headlines, and actually lots of the companies we know and love are doing better than they ever have. So that's it from us. I'm doing a shameless plug on this slide. So this is just happens to be a brand survey slide that just fell into the presentation that I won't go on too much. That says we're really good. And that's kind of it from the form bit. So Luke and my details are there. I know lots of you know us already, and hopefully can attest to the fact that we're pretty happy to just spend time to get you to understand this stuff. It's a complicated area. It's also kind of super idiosyncratic to what your family setup is, what's going on in business, what your attitude to things like tax are. So if you do want to have a chat with us, maybe this isn't the forum to talk about your personal finances, but we're happy to answer any sort of general questions on here if there's time, which I think just about is, AJ. Sorry, we're over.
No, that's great. Thank you so much, Nick and Luke. That was incredible. Really, really informative. And I'm just reposting this link in the chat because we're now going to jump on to questions, of which the top one that's been upvoted 5 times is: how much money do we need to have to use Evelyn Partners wealth management services?
So more than £20,000, I'd say. And the reason I say that, and it's a bit of a glib answer. So within our business, there are solutions that allow you to do it yourself. There are solutions that allow you to do it through a Nutmeg style portal. There are solutions that allow you access to passive tracker strategies. So there's always, there's a way that we can help you with your financial well-being if you have more than £20,000 to put to work. Clearly, as the number gets bigger, it's crude to say, things tend to get more complicated. The level of, inclusion of different advisors goes up. So there's a kind of it's a horses for courses. But if you want to have a chat with us, we'll definitely direct you in the right place within the business.
Amazing, thanks, Nick. It's a high bar, but I think we can reach it. So the next question, which has also been upvoted 5 times, which is: what happens to our pension pool if we move abroad?
And for me, that ultimately UK pensions are portable. So there's a piece of HMRC regulation that basically says if you want to move your UK pension overseas, you need to move it to a jurisdiction where we have what's known as a recognised overseas pension. Effectively, that means the pension administrators are willing to be open and transparent with HMRC about data. If you go online, if you Google recognised overseas pension schemes, HMRC actually publish a list of them in different countries. Some countries have been sort of barred because they were doing things that HMRC didn't like, but most of the jurisdictions, in my experience, that people might want to move to will have vehicles that are able to accept transfers from UK schemes. it's worth saying that you can leave your pension in the UK. And if you need to take an income from it, you can draw that overseas, and the taxation will depend upon the double taxation agreement between the UK and your country of residence. And it's also worth saying that you needn't necessarily transfer your pension to the jurisdiction that you live in. So I've seen plenty of examples where, I don't know, people will go and live in XYZ country, but actually the pension regime is more attractive for them in ABC country, therefore they'll hold it there. So lots of flexibility. A UK pension doesn't cease. You can do what you want with it ultimately.
Amazing, thank you, Luke. Really helpful. Then next is, what do entrepreneurs do who want to pass wealth to their children without spoiling them? Or of money psychology or social psychology?
Yeah, well, I mean, it's a brilliant question, and look, I mean, the reality is it applies to all people with wealth. How do I pass the next generation without disincentivizing them is point one, and point two is often about loss of family wealth. I give money to my kids too soon, they get married, then they get divorced, and half the money walks out the door. So that's been a perennial issue. I guess thinking specifically about this community, I guess what Nick and I hear a lot of is, I want my kids to be hungry. I want them to go out there and hunt and create value in the same way that I have. And in those scenarios, Nick and I have sort of structured things to try and incentivize that. So I mentioned that trust structure earlier. Well, theoretically, you could use a trust structure and say, look, this trust exists to support my children with the development of a business, for instance. So if a business is being founded, we'll create seed capital for that. If not, trust doesn't make a distribution. Another scenario we've seen is sort of just incentivizing people to work. So look, if they know mum or dad sold for 100 million, are they rushing out to get that 50 grand a year job? Possibly not. But again, Nick and I have devised scenarios in which we say, look, if you work and you earn X, we'll match it or we'll enhance it. And certainly one scenario, one of our clients was quite happy for their kids to go and work in the city, but actually one of the girls wanted to go and be a nurse, where they sort of doubled her wage to reflect the fact she was putting something back in community. So for me, it's a very family specific question, but there are loads of different levers that we can use to make sure that you are releasing income or capital to the kids at the right time. And the one thing I know for sure is that this stuff gets way easier as you and your kids are older. And that's why the offshore bond is quite a popular one, because frankly, you invest in your own name, you control it, you own it. If you want to spend it, you can spend it. But equally, if the time's right to make gifts in the future, you just gift some or all of that structure to them.
Brilliant, thanks, Luke. The next question down is any M&A advisor recommendations for potential acquisition of 3 to 10 mil? Most around seem to be interested in 20 plus mil.
I think you're going to find that most are 20 plus mil, but we have an M&A advisor in-house, I would say this, but he does a lot of deals in that space. So if anybody wants to have a chat with him, feel free. I can connect you up. And again, he'll be very happy to spend an hour or two with you just talking high level market stuff, not with a clock on or anything like that.
Great, thanks, Nick. The next one's related to 2 questions before about pensions and what happens if you move abroad. Same question applied. What happens to an ISA if you move abroad?
Yeah, good question. So when you move overseas, you cease to have the ability to save money into an ISA. So that 20,000 allowance that we're saying you should use systematically, that stops. That's gone effectively on day one. What doesn't change is the ISA advantageous status. So specifically the fact you don't pay tax on income or tax on gains. However, and it is a meaningful however, that's a UK rule. So you will never pay UK tax on your UK assets that you accumulated whilst a UK resident, no matter how big they grow, no matter whether you spend, you know, the next 20 or 30 years overseas. However, it is not implausible that you might pay tax in the jurisdiction that you move to. And just to give you a quick and obvious example, you know, those of you who've had any dealings with the US tax system, they look right through ISAs. So they ignore the fact that the wrapper is there and effectively tax the underlying investments. So you can have investments in the UK that are tax-free as far as the UK regime is concerned, but taxable, you know, but taxable effectively in your country of residence. So look, I mean, for me, moving overseas, for some people it's about lifestyle. For others, it's about tax. Really getting into the weeds of the taxations are a really, really important consideration.
Yeah, we have lots of clients that that we look after pre-existing ISAs because they go somewhere for work and they think they might come back. So what they can't usually do is contribute to the ISAs, but we can keep them running and invested, and they won't lose any benefit of previous year's contributions. So it's a bit, again, it's a bit of a horses for courses, but.
Brilliant. Thank you both, Nick and Luke, because we're going to have to wrap up now. We've got 2 minutes left. And so I just want to give you guys some space. Any immediate call to actions to the group or any final words?
Well, like we say, well, first of all, thank you for giving us the time. But like we say, really happy to invest some time, get you all up to speed on these concepts. We really did canter through that post-liquidity structures chart, but there's a lot of information in there where we could do a whole session on each of those different structures and the way that they're deployed. So yeah, just kind of think of us as people you can call on for a bit of information and education on this area. I'm happy to give you guys any pointers.
Brilliant. Thank you so much, Nick and Luke. Thanks everyone for turning up. And yeah, I will forward on all of the presentation, the recording and contact details after this. But yeah, otherwise, have an amazing rest of your Tuesday.
Thanks
everyone. Bye.